the physical demand for gold has never been stronger. So we're always told that people need to liquidate their gold because they need to raise money. And yet the demand for physical metal, I mean, when you think about it last week, there were 43,000 COMEX gold contracts that were shunted to the London market in a procedure called an exchange for physical. Okay? Well, 43,000 contracts of COMEX gold futures amounts to 135 metric tons of gold that has ostensibly been shifted to London, where it's going to be exchanged, those contracts are going to be exchanged for physical metal. So 135 metric tons of gold, Dunnigan's worth $47 billion. So that means last week alone, there was a minimum of $47 billion worth of physical buying. But no one talks about the physical demand or the physical buying. And frankly, I doubt whether 135 metric tons of gold exists in London or is for sale anywhere in London. Interest rate derivatives are used for other reasons that are beneficial to the powers that be, because utilizing interest rate derivatives, you can make banks captive buyers of U.S. government debt at any time of your choosing. This is a feature that they're never going to get rid of, because this is how they can continue to issue insane amounts of debt. Even though there's no natural buyers, they can make the commercial banks captive buyers of any amount of debt they want to issue.
As a responsible person with growing concerns for your privacy and personal liberty, you want to know where we're headed and what you can do about it. We ask the experts what you need to do to take prudent and responsible action to safeguard your family's wealth and well-being, and what basic first steps will help you to be aware and prepared. ReluctantPreppers.com.
Welcome back to Liberty and Finance and Reluctant Preppers. Today is Monday, March 2nd, 2020. We have a returning guest who's wildly popular with our viewers. Rob Kirby is a proprietary analyst, well-versed on both the precious metals markets as well as the credit markets and the financial markets, and he brings us into perspective on how all those things are tied together and to the future of our lives. Rob, thanks for joining us again here on Liberty and Finance.
Wonderful to be with you again, Dunnigan. And I'm actually learning a little bit about viruses too.
Oh man, aren't we all? Yeah, we've got some upcoming travel, and we're watching and seeing how things play out. So
you're a braver man than I.
Well, we just got back actually from travel a few weeks ago and got over some colds from that, and now we're trying to hold it together in between now and our next travel. So,
well, good luck to you.
Yeah, thank you. And we wanted to, first of all, if you could kind of bring us up to date on a mysterious phenomenon that's been going on for almost half a year now, these bond repo actions by the Federal Reserve, which have never been coherently explained by the actual people doing them and the powers that are doing them, so leave the rest of us guessing as to what's going on, but it doesn't look or smell good. Can you tell us what we do know to this point and what your analysis is leading you to believe about what's driving this and where it's heading?
Well, this whole repo issue, when it was initially sort of thrown into the public domain, was supposed to be about a temporary need or requirement for liquidity, because it was argued by some people at much higher pay grades than I that banks were going to require this additional liquidity so they could square their books to get them over year end. And it seems to me that this liquidity add, which, the repo market is supposed to be a temporary, like the real purpose of repos, the way they were invented the purpose they were supposed to serve was that when there were temporary mismatches in government receipts or in bank receipts, like timing issues when governments have to, for instance, make payments for tax returns, and therefore that, like, as that money is sitting on the sidelines in government accounts, and when the government remits tax returns to the citizens, the citizens take the check from the government and they put it in their bank account. And the banks, of course, anticipate this. And with our just-in-time world, when banks anticipating injections from their customers don't get them in a timely, maybe there's a breakdown in the writing of the checks from the government, the repo market's there where banks and financial institutions can raise liquidity themselves by doing temporary sales and repurchases of inventory they have on their books to get them over basically a cash crunch that typically it's measured in very small numbers of days. But you see, this activity started last September and it's still going. And it's not just temporary, because we have permanent purchases of $60 billion worth of T-bills on a monthly basis being concocted by the Fed, and you can say the Treasury too. But in addition to that, we have somewhere between. I was keeping a running total on it back last month, and I figure in this temporary cash through the repo, overnight and 14-day repos, roughly 160 to 190 billion on a daily basis is being injected short term. And then add to that the 60 billion a month that's being taken out or being added on a permanent basis through the purchase of T-bills. And it doesn't really look really so temporary anymore. Mm-hmm. I mean, Don, again, if I lend you 230 billion and you never repay it, it's not really a temporary. It's actually really what it is bad debt. And
that would be just fine with me, Rob. Anytime you want to do that.
But to say like 6 months later to say that this is temporary is really it's a laughing joke. And that is why we are seeing the likes of Jamie Dimon making pronouncements that, it's not so bad. It's not so bad if people use the discount window and borrow money direct from the Fed instead of going through these concoctions of these farcical repos. Mm-hmm. Because you see, like historically, we talked about this before you started recording, and because you would question me about Jamie Dimon's...
Right, there's a question we have from Flaming Lamborghini who said, what do you make of it, Rob, when Jamie Dimon announced last week that J.P. Morgan will access the Fed's discount window?
Yeah, well, my take on that is that, you see, historically, banks were looked upon in a very negative light by the Federal Reserve if they accessed the discount window, because it was highly suggested that the banks were derelict in the management of their reserves and in managing their business. But you see, when you've got these institutions that need money on a perpetual, it's temporary, of course, but a perpetual temporary basis. And people are starting to ask, very unfavorable questions about the state and why so much repo activity is being undertaken. Jamie Dimon makes a pronouncement that maybe J.P. Morgan will start accessing the discount window to break the stigma of an institution not being managed well if they access the discount window. And this way, it's like basically what Jamie Dimon's doing is he's laying the groundwork to destigmatize the use of the discount window, because if discount window borrowings increase, you could make a strong case that repo activity would be able to be decreased as well. And this is a way of deflecting some of the liquidity requirement away from the repo function and putting it into discount window borrowings, which most institutions are extremely reluctant to do. So, they bring on one of their generals, Jamie Dimon, to destigmatize this activity of accessing the discount window. That's the way I see it, and I think that's really what's behind it all.
We have a question from a viewer named C, who says, Mr. Kirby, what are the chances that the global coronavirus outbreak and the cratering global economy are, quote, coincidental? If not so coincidental, what's the underlying signal?
I don't believe in coincidences to begin with. To me, this whole coronavirus issue is come right out of the globalist playbook. So any way you look at it, to me, like I don't believe it was an accident. You know, we were initially told, if you recall, Dunnigan, that this thing came from a meat market in China, and because people were eating bat soup and whatever bat and whatever other rodent that might have been
monkeys, rats, yeah,
monkeys and rats. And anyway, I don't buy any of that for a minute. If you pay attention to the likes of Francis Boyle, who was the architect of the bioweapons treaty adopted by America back in the 80s and subsequently adopted by the United Nations as a global treaty, he has produced and shown documentation that the coronavirus, or this Wu flu, or whatever you want to call it, COVID-19, I love the names they come up with for these things, but he has produced documentation showing that the insertion of AIDS, HIV, and this virus, it bears the scars of being worked on in a biolab. And apparently geneticists and epidemiologists with the chops to know better can look at this thing and they can tell that it was created by man. And the genesis of this, according to Boyle, and he says he's got the documentation to prove it, it goes back a few years. The virus was created in Fort Detrick, Maryland. It was transferred to University of North Carolina, and the University of North Carolina sold it to the Chinese in 2015. And there's very good documentation to say that this is exactly what happened. What the Chinese did with it after they had it in the confines of their bioweapons level 4 lab in Wuhan, and whether it was released by accident or on purpose, is open for debate. But the genesis of it is not open for debate, and we know where its roots are and where it came from. So the genesis was Fort Detrick to the University of North Carolina, sold to the Chinese, and the Chinese worked with it in their lab in Wuhan. And if I recall, the Bio Level 4 lab in Wuhan was run by a very highly acclaimed professor from Harvard, who ran the biolab for Wuhan, for the Chinese in Wuhan. So whether it was, let's just say he without a doubt was a globalist, and whether this was released on purpose by the globalist, which is where my sentiment lies, or whether it got out by accident is almost irrelevant. It's in the wild now, and it's moving at a ferocious pace around the world.
From your standpoint, and I know this isn't your main area of focus, but what arguments do you hear or have you thought of that are justifiable for any country or anywhere to be doing research, development, and experimentation with extremely hazardous, bioweapons? What's the rationale? I can only imagine starting with like Cold War. Oh, we're gonna come up with a weapon that we can use against our Cold War enemy, and then it's like, yeah, but that doesn't make any sense. Once it's out, as you point out. How do you prevent it from blowing back on you? Well, we need to research it for developing inoculations against those people who are doing that on the other side. But what's the real justification?
Well, my view is that, and believe it or not, it was back when Francis Boyle wrote the bioweapons treaty in the 80s, dealing with this topic, it was initially suggested that anybody caught doing work in this area, creating biological weapons that could destroy or take out humanity, should be put to death. And Francis Boyle disagreed with the notion of putting people to death. And that's one place where I think Francis Boyle is wrong. And I do believe, frankly, personally, anybody caught engaging in this activity, in my view, is an enemy of humanity, and they forfeited their right to exist on this planet, and they need to be put down, because you know what, humanity just doesn't need this. Okay, this is ridiculous, and to sponsor or allow this kind of work anywhere only tells you or gives you an idea the depravity of our leaders if they're allowing or encouraging this type of work, because this is a no-no. Okay, this is and allowing people to work on this, to me, is like giving 6-year-olds nuclear triggers and telling them to go play with them out in the sandbox. And this is obscene, and it's an insult to humanity. And you know, it's insulting to what we widely regard ourselves as an evolved species. This is not the activity of an evolved species at all. This is the action of a morally bankrupt and devolved entities. So, and there's some rather choice words I could use for what I really think of humanity that's done this. It's called species not so smart, and but with more colorful language, and this should not be tolerated. Period. And because this is death science. This is nothing but death science, and it should not be tolerated or promoted anywhere. And if President Trump could do anything for the betterment of humanity, he could absolutely outlaw and have all these bioweapon level 4 labs shut down, which is what Francis Boyle encourages as the appropriate action to be taken. And you see, this Francis Boyle, he was the guy. He was a media darling back in the 80s with his cutting edge work and the legislation that he framed regarding bioweapons. But it was back in the early 2000s, in the SARS epidemic, that Francis Boyle came out and correctly identified SARS as being a bioweapon. That was also designed in a lab. But the SARS virus apparently was not as virulent as the COVID-19, or SARS-2, they're calling it. When he came out in the early 2000s and said that SARS was a man-created virus, designer virus, he was blackballed by the media, and he's never had a mainstream interview since. But he's still out there, and he does give interviews quite generously in the alternative press, and very sage words from a very smart guy who knows an awful lot about all this. And I would refer to him very likely, if not the leading, certainly one of the leading practitioners in this area, with vast amounts of knowledge on these viruses, bioweapon viruses. So anyway, Francis Boyle is his name, Boyle. You can Google his name, and he's done quite a few interviews recently, and you can listen to them. And the man speaks very coherently about all of this, and he explains where his documentation has come from.
And my wife and I are particularly sympathetic, besides the fact that we're all subject to what is going to happen with this COVID-19 virus, in that my wife and I are both Lyme disease survivors, and that has its own infamous story of potentially originating near Lyme. Well, Lyme, Connecticut is where it started originating, but just 9 miles off the shore there is Plum Island, which was a military bio research lab.
Yep.
And anyway, now there's still an outstanding request from the U.S. Congress to the military to explain whether or not they were in fact experimenting on tick-borne illnesses and ticks at the Plum Island laboratory. They haven't been answered yet. They haven't got an answer yet back at the military on that. So,
yeah, I'm sure they'll get back to you soon.
There's a related question here from Victory CSA who asks, with the global supply chain all but shut down by the coronavirus pandemic, how much longer can the world central banks continue printing unending amounts of fiat currency in order to prop up stocks and bonds without causing a massive rise in consumer prices, inflation, and a rapid rise in the price of physical gold and silver?
Well, as per what we witnessed last week with the initial rise in the price of gold last Monday, and which, by the way, if you haven't noticed, the dramatic rise on Monday in the price of gold did not create or force a short covering rally. Instead, they waited till Tuesday, and they jumped the price of gold and then explained the $132 price collapse in futures prices by saying that all the players that were long, of course, got margin calls. But the day before, when the price went up, nobody got a margin call, and the shorts weren't instructed to cover or forced to cover or have their short positions liquidated. No, but on Tuesday through Friday, all the longs got liquidated because, of course, they had to meet margin calls. And then as the prices were falling, of course, the COMEX right on cue. The COMEX they increased. Well, once it was ordained that they were going to sewer the price, of course they raised the margin requirements on futures contracts, which only exacerbated the collapse. I mean, you see, they never really raise margins on COMEX futures when the price is going parabolic up, which it's only done so on a couple of occasions in the last 11 years anyway. But boy, once they get the market, gaining a little bit of speed to the downside, that's when they pile on with the margin increases, and which absolutely exacerbates the collapse. And when you juxtapose the collapse in the paper price, while the demand for physical metal and the purchasing by central banks around the world, not so much in the Western world, but let's just say in other parts of the world, the physical demand for gold has never been stronger. So we're always told that people need to liquidate their gold because they need to raise money. And yet the demand for physical metal, I mean, when you think about it last week, there were 43,000 COMEX gold contracts that were shunted to the London market in a procedure called an exchange for physical. Okay? Well, 43,000 contracts of COMEX gold futures amounts to 135 metric tons of gold that has ostensibly been shifted to London, where it's going to be exchanged. Those contracts are going to be exchanged for physical metal. So 135 metric tons of gold, Dunnigan's worth $47 billion. So that means last week alone there was a minimum of $47 billion worth of physical buying. But no one talks about the physical demand or the physical buying. And frankly, I doubt whether 135 metric tons of gold exists in London or is for sale anywhere in London. So this is another game of optics, and it's another game, I call it hide the salami. And how do we invent a reason or a rationale or an explanation for the long arm of the Exchange Stabilization Fund, whose footprint we see in our capital markets on an increasingly frequent basis, with fundamentally outcomes that are fundamentally counterintuitive. I mean, normally you see, Dunnigan, when the stock market melts down, normally the first thing that people think of isn't to sell all their gold. Okay, it's sort of like when you go into the desert. The first thing when you go into the desert, you don't say, "Oh my God, I got to get rid of all my water." It's so counterintuitive. It's ridiculous. But when the financial world looks like it's coming to an end, people don't intuitively say the first thing I'm going to sell is my gold. Historically, that wouldn't happen. It's like when you have a headache, you throw all your aspirin in the garbage. It's ridiculous. Or you give your aspirin away. Why? Because I have a headache. I mean, it doesn't make sense, and it doesn't ring true. And of course so what did go up last week? Government debt that will never be repaid under any circumstances, and there's going to be more issued in short order, additional debt that will never be repaid. Okay, and gold gets trashed. Sorry, not on my planet.
We've heard the justification for that action that seems counterintuitive, in that if ordinary stockholders have shares that are leveraged with margin and that sort of thing in their accounts, and their shares are selling off and hit margin requirements, that the margin clerk for the brokerage, not on the behalf of a decision on the part of the investor, would liquidate anything that had a bid in order to meet the margin requirements. Do you think that's a defensible argument for how that can happen?
Well, I mean, I'm not saying in some cases that didn't happen, but I mean, the reality, Dunnigan, there's no physical gold backing these contracts anyway, but yet they claim that these things, and ostensibly these things, are supposed to be settleable in physical metal, because the futures are supposed to stand for the underlying commodity. So, the argument that margin clerks are making these decisions and we're liquidating because margin clerks might very well have been liquidating people's positions because they bought futures contracts on leverage and the price dropped dramatically, but that doesn't explain very well the shunting of 43,000 contracts to London in exchange for physical
delivery, right?
But supposedly for physical delivery, which if physical delivery really occurred, that implies there was 45 or 47 billion dollars worth of physical buying last week. So and the notion that nobody wants gold, and yet there's $47 billion worth of purchases for 135 metric tons in 1 week in London. Those two things don't jive.
Right. We've been hearing about that from Bill Holter. He's been reporting on that phenomenon, especially in recent weeks, that there's been basically an unsatisfiable demand for these physical deliveries being shifted from the COMEX to the LBMA, and wondering what
135 tons of gold, Dunnigan, is a lot of gold.
Oh yeah.
A number of years ago, not that many years ago, Germany asked the Federal Reserve to get some physical gold back that they had on deposit in trust at the Federal Reserve. And when it took Germany 3 years allegedly to get any. I mean, they were outright told no when they first said, well, we want some of our gold back. And the Fed just said no. So if gold is so plentiful that you can shift 135 tons worth of exchanges for physical off the COMEX exchange to London, and supposedly that they get settled or satisfied, why is there a problem for anyone to ever produce or make good on physical demand, in a transparent way in the Western world? It's Anyway, the story has more holes in it than Swiss cheese.
It doesn't look or smell right, and it makes it look like there is not sufficient.
Smells like Limburger cheese,
yeah, that's right.
Swiss cheese.
And it makes it look like there's not enough physical to satisfy those standing for delivery on the Comex, for one thing.
Well, exactly. You see, on Comex, no physical gold basically never leaves the inventories. It's been more or less stagnant now for a long time. Like a long time. And gold, there's never a big offtake of gold from New York, from the Comex depositories. There's never a big offtake, ever. And, they're supposedly one of the world's leading gold exchanges. Supposedly they have metal to back their contracts, but yet nobody ever takes any out.
Interesting. We've had a request from a viewer to ask if you could take us back to grade school, and you've talked a couple of times why negative interest rates would never work in the USA, and I know you've taken a couple runs at that with us, but help us to understand why you think that plays in Europe but not in the US.
Okay. In Europe, underpinning the euro, there is no massive many hundred trillion derivatives complex, whereas with the dollar, the world's reserve currency, you can look at the BIS statements on derivatives, and you can look at the Office of the Controller of the Currency, which gives a breakdown of derivatives holdings by American financial institutions, and the swap market. And what the interest rate swap market is, it's an exchange of fixed rates for floating rates, and in an interest rate swap, particularly, I was going to say particularly between 3 and 10 years. And these trades between 3 and 10 years, they have a cash bond trade embedded in them. But the contract price is party A pays fixed and party B receives floating 3-month LIBOR. So if you have a participant paying, let's just say 5-year fixed rate, and I know swap spreads right now are negative. So I believe the 5-year bond's probably yielding around 75 basis points or thereabouts right now. And the spread on the swap is actually, I think, negative probably 8 or 9 basis points. So that means that if you consummate a trade in a 5-year interest rate swap, the fixed rate side is going to pay 75 basis points less, let's say 8 basis points if the spread is at -8. So that means the fixed rate pair is going to pay 67 basis points for 5 years on a notional amount. So let's just say it's 100 million. You're going to pay 67 basis points on 100 million for 5 years. Every year that, you pay out 67 basis points. In return for you paying the 67 basis points, the other side of the trade, which is the ESF, but sorry, I didn't really say the ESF. The ESF is going to pay you 3-month LIBOR. Well, if 3-month LIBOR is negative, I'm paying both ways. And that blows up the entire derivatives complex because there's hundreds of trillions of these things outstanding. Right. So what that would do would predominantly in the marketplace, it's the U.S. Treasury, the Exchange Stabilization Fund, that is the side of the trade that lent the fixed and is paying the floating. So if banks suddenly are paying fixed at a positive rate, and then they have to pay negative, if 3-month LIBOR goes negative, then they have to pay again. And then that trade that you thought was going to be profitable, you blow up because you're getting it both ways. Like the trade's supposed to work that when you pay fixed, you're being compensated with an income stream to allow you pay the fixed. But if you're paying on both sides, the trade breaks down. It's a paradox. You can't have you can't have water falling and rising at the same time. When water goes over a fall, it goes down. But if water started falling up, the whole equilibrium of the time-space continuum would there'd be a wrinkle in it. There'd be a problem. So banks can't afford to pay on both sides of these trades. Plain and simple. They can't afford to. It will blow up. It would blow up. The institutions that it would blow up instantly would be J.P. Morgan, Bank of America, Citibank, Goldman Sachs, Morgan Stanley, Wells Fargo. They'd all be dead. They'd be dead. They'd be dead in a day. Dead in a day. And it can't and it won't happen. Okay? So we're never going to see 3-month LIBOR go negative because the derivatives complex in dollars prevents it from doing so. Now, we have negative rates in the Euroland, but they don't have this derivatives complex underneath the euro. Understand, the euro only came into existence in after the millennium. The dollar derivatives market's been around since the early 80s. And it's just ginormous. And it doesn't work with negative rates. It would basically mean you'd have to shut down, or basically you'd have to cash everyone out of their derivatives. And I mean, interest rate derivatives are used for other reasons that are beneficial to the powers that be, because utilizing interest rate derivatives, you can make banks captive buyers of U.S. government debt at any time of your choosing. This is a feature that they're never going to get rid of, because this is how they can continue to issue insane amounts of debt. Even though there's no natural buyers, they can make the commercial banks captive buyers of any amount of debt they want to issue. And this has been used in this fashion for many years, last 20 years in particular. You see, this derivatives complex really mushroomed with the removal of Glass-Steagall in 1998. It basically took the bridles off of the investment banks from, it turned them into riverboat gamblers with the proliferation and mushrooming of interest rate derivatives that ensued. And this is a cozy relationship between the commercial banks and the Treasury and the Fed, which is the ESF's, this clandestine adage of the U.S. Treasury, the Exchange Stabilization Fund. They work through the Fed as their sole broker. And so all ESF financial transactions are routed through the New York Federal Reserve Trading Desk. And the cozy relationship is that the commercial banks that engage in interest rate derivatives with the ESF via the Fed, they get to make basically what amounts to risk-free profits. So it's very profitable for the banks to be engaged in this business. And it's a very cozy relationship for the Treasury, because they get to basically auction off any amount of debt, and they can create transaction demand for any amount of U.S. government debt they want to issue by engaging in these interest rate derivatives, which make the banks captive buyers. And, U.S. Treasury debt all settles in dollars, and interest rate derivatives are all dollar products. And in this way, these investment banks, which are no longer subject to capital restrictions when Glass-Steagall was in effect, they can do limitless amounts of these things, and the margins are slim on these things. Understand? But when you've got a $50 trillion book, you don't need to make a lot of money or a big spread on 50 trillion to make it very impactful on your earnings. And I mean, you've got institutions at one time or another. Let's just say every one of the institutions of J.P. Morgan, Citibank, Bank of America, Goldman Sachs, and Morgan Stanley. Every one of these institutions at one time or another have had derivatives books in excess of 50 trillion in notional. And they don't all have books that size now. I think Morgan Stanley's book currently stands around 39 trillion. I believe Goldman is right at the 50 trillion mark. JP Morgan is right at the 50 trillion mark. Bank of America, I think, is 46 or 48 trillion. And Citibank would be in the mid $40 trillion size as well. And these banks have at times, like the high water mark for JP Morgan, I think, was 84 trillion in notional. And that was back, going back 7 or 8 years ago. And Deutsche Bank used to be a big player in this as well. But their regulator, BaFin, a number of years ago, got very upset with Deutsche Bank, who was a big wheel in that trade, until German regulators' hair was lit on fire when they realized that Deutsche Bank was acting more like an American bank than a German bank. And they read the Riot Act to Deutsche Bank a number of years ago, and Deutsche Bank's derivatives book has been contracting at an enormous pace ever since. So anyway, that's the reason why. So that's why we have that's, in a nutshell, that's why American interest rates can't go negative, because it would upset this multi-$100 trillion derivatives edifice, and it would destabilize it, and it would destroy the banks. Can't be done. At least I would maintain it can't be done. So anyway, it'll be very interesting to see if they try.
Right. Because
it's sort of like putting a stick of dynamite up your behind and lighting it and saying, nothing bad can happen here.
Wow.
And don't think it would work out too well for anyone engaging in it.
Well, Rob, we've got more questions than we're going to have the ability to ask you this time. We're going to have to ask your permission to get you back here again soon. We've been speaking with Rob Kirby, proprietary analyst, and people can find you online at
kirbyanalytics.com.
Thanks, Rob, for joining us here again on Liberty and Finance and Reluctant Preppers.
My pleasure.
Reluctant Preppers provides educational awareness and commentary only. Opinions expressed do not constitute personalized financial advice. Viewers are encouraged to do their own research and seek qualified personal financial consultation before making investment decisions.